Imagine you wake up one morning, check your portfolio, and everything looks fine. Your S&P 500 index fund is up, your tech stocks are humming, you've done everything right, diversified, patient, long-term. And then you read one headline about tariffs or a trade war or some geopolitical crisis halfway across the world, and suddenly your perfectly diversified portfolio drops 4% in a single day. And you're sitting there thinking, why? I own 30 different companies. How is something happening in Taiwan affecting my retirement account in Ohio? That feeling right there, that confusion, that helplessness, that's not a you problem. That's a system problem. And the system is changing faster than most investors realize. My name is Smith, and I spend way too much time thinking about how global economics shapes your personal wealth. If you're someone who's worked hard to build an investment portfolio, but you're starting to feel like the old rules don't quite apply anymore, like diversification isn't protecting you the way it used to, like something fundamental has shifted, but nobody's explaining it clearly, hit subscribe and give this video a thumbs up, because what I'm about to walk you through could genuinely change how you think about every investment decision you make for the next decade. Here's the thing. For the last 40 years, the global economy operated on one central assumption, that trade between countries was a good thing, that specialization, China makes the electronics, Brazil grows the soybeans, Germany builds the cars, America designs the software, that this interconnected web of production made everything cheaper, more efficient, and more profitable for investors. And it did, for a while. The era of globalization lifted hundreds of millions of people out of poverty, made consumer goods affordable for the middle class, and powered one of the longest bull markets in history. But that era is ending, and most retail investors have absolutely no idea what to do about it. Now look, I'm not here to be dramatic. I'm not wearing a tinfoil hat. When I say the end of globalization, I don't mean that international trade disappears overnight. What I mean is that the rules governing global trade, the assumptions baked into your investment portfolio right now, are being rewritten in real time. And if you don't understand the new rules, you are going to keep experiencing those confusing gut punch days where your portfolio bleeds for reasons that feel completely out of your control. Let me give you a number that should stop you cold. At the peak of globalization, around 2008, global trade as a percentage of world GDP hit nearly 61%. By the mid-2020s, that number had been declining for years. Cross-border investment flows dropped by nearly half from their pre-2008 peak. Supply chains that used to stretch across 15 countries are being deliberately shortened. Governments are spending trillions. The United States alone committed over $500 billion through the CHIPS Act, the Inflation Reduction Act, and related industrial policy, specifically to bring manufacturing back home. This isn't a trend. This is a structural transformation. And structural transformations don't just affect politics. They affect where money flows. They affect which companies win and which ones collapse. They affect your retirement. Here's what most people don't realize. The investment playbook that made people wealthy over the last 4 decades was built on a globalized world. When you buy a broad market index fund today, you're essentially betting that the system which created those returns, cheap labor arbitrage, frictionless global supply chains, low tariffs, stable international institutions, continues to function. And that bet is getting riskier by the day. Let me paint you a picture of how we got here, because understanding the origin story is everything. After World War II, the United States essentially architected the global economic order. Bretton Woods, the IMF, the World Bank, the General Agreement on Tariffs and Trade, which eventually became the WTO. The whole system was designed around one idea. If countries are economically dependent on each other, they're less likely to go to war. Trade as peacekeeping. And for decades, it worked remarkably well. Then China joined the WTO in 2001, and the integration deepened even further. Multinational corporations found they could manufacture goods for a fraction of the cost by moving production to countries with lower wages and looser regulations. Profit margins expanded, stock prices soared, shareholders got rich. But here's where the psychology gets really interesting. When things are working, nobody questions the system. Investors piled into global supply chain stocks, into emerging market funds, into companies with complex multinational operations because that's where the returns were. The system was rewarding complexity and global integration, so naturally the entire financial industry, the index funds, the ETFs, the mutual funds, the pension funds, all got built around the assumption that this system would persist indefinitely. This is what behavioral economists call recency bias on steroids. We don't just assume the recent past will continue, we build trillion-dollar institutions around that assumption. Now, you might be thinking, okay, fine, globalization is slowing down, but isn't that a problem for governments and CEOs to worry about? Why should I, someone just trying to grow my retirement account, care about any of this? I'll tell you why. Because the death of one era is always the birth of another. And in the transition period, right now, the period we're living through, the wealth transfer is absolutely enormous. The investors who understand what's happening will compound their money at rates that would make the previous generation jealous. And the investors who don't, they'll spend a decade wondering why their portfolio is flat while certain sectors are up 300%. This is where it gets interesting. Let me walk you through the 3 fundamental shifts that are reshaping the investment landscape, and then I'll show you exactly how to position your money around each one. The first shift is what economists call reshoring and friendshoring. For 40 years, corporations chased the cheapest labor on earth. And it made sense. If you can pay a worker $2 an hour instead of 20, your margins look beautiful. But then COVID happened. And suddenly, a factory shut down in Wuhan caused car dealerships in Michigan to sit empty because they couldn't get semiconductor chips. Hospital systems ran out of surgical masks because 90% of them were made overseas. The entire developed world had a simultaneous realization. We have optimized for efficiency at the cost of resilience, and we will never make that mistake again. So now, governments are paying companies to build factories at home. And I don't mean gently encouraging them, I mean writing enormous checks. The CHIPS Act in the United States provided $52 billion in direct subsidies to bring semiconductor manufacturing back to American soil. Taiwan Semiconductor, TSMC, is building a $65 billion facility in Arizona. Intel is constructing new fabs in Ohio. Samsung is building in Texas. The European Union launched its own CHIPS Act worth $47 billion. This is not small money. This is the largest government-directed industrial investment since the space race. And every dollar of that investment has to flow through companies, through construction, through materials, through labor. That's an investment opportunity hiding in plain sight. Now here's the psychological trap most investors fall into. They hear semiconductor manufacturing and they think of the flashy AI chip companies, NVIDIA, AMD, and they pile in there. And look, I'm not saying those are bad investments, but the real money in an industrial renaissance is often not the marquee names. It's in the picks and shovels. During the gold rush, the people who got reliably rich weren't the prospectors. They were the people selling Levi's jeans and pickaxes. When the world is building new domestic factories at record speed, the boring companies, the ones making industrial equipment, power infrastructure, construction materials, quietly become extraordinary performers. Consider this. To build a modern semiconductor fab, you need ultra-pure water systems, specialized HVAC, earthquake-dampening foundations, and enough electricity to power a small city. The companies that make those things are not glamorous, but they are right now sold out backordered for years with pricing power they haven't had in decades. That's a business I want to own. The second shift is the weaponization of trade, and I want you to really understand this one because it's psychologically the hardest for investors to grapple with. We've been trained to think of geopolitics as noise, the kind of thing that temporarily rattles markets but doesn't change the underlying fundamentals. Don't panic, stay invested, geopolitics always blows over. And that advice was correct for a long time, but it was correct because the underlying global trading system kept chugging along beneath the political drama. Now, the trading system itself is the battlefield. Tariffs, export controls, investment restrictions, sanctions, these are no longer just political gestures, they are precision economic weapons. When the United States restricted the export of advanced semiconductor chips to China, it wasn't a trade dispute, it was a strategic move to deny a rival nation the raw material of modern military and economic power. When Europe cut off Russian energy imports overnight after 2022, it wasn't a market event, it was a fundamental rewiring of an energy system built over 50 years. Here's the number that should make every investor sit up straight. According to the IMF, full economic decoupling between the US-led bloc and the China-led bloc could reduce global GDP by up to 2% permanently. 2% of global GDP sounds boring until you realize that's roughly $2 trillion in annual economic output gone. Not transferred, gone. That's the cost of inefficiency when you rebuild parallel supply chains, parallel financial systems, parallel technology stacks. For investors, this creates a very specific risk and a very specific opportunity. The risk is holding companies that are deeply exposed to cross-block trade, companies that manufacture in China for American consumers, or that rely on Chinese rare earth materials, or that depend on Russian energy inputs. These companies face a structural headwind that no amount of good management can fully overcome. The opportunity is in companies that help countries and corporations navigate this new reality. Cybersecurity firms protecting critical infrastructure, defense contractors supplying both deterrence and intelligence, companies that produce critical materials domestically, copper, lithium, rare earths, that governments are now desperately trying to secure at home. The third shift, and this one is perhaps the most profound, is the return of inflation as a structural feature of the economy, not a temporary blip. And I want to be careful here because I know the word inflation has been beaten to death over the last few years, but I'm not talking about the 4 to 9% inflation panic of 2022. I'm talking about something subtler and more permanent. Globalization was, among other things, a 40-year deflationary force. Every time a manufacturer moved production to a cheaper country, prices fell. Every time a supply chain got longer and more optimized, goods got cheaper. That process is now running in reverse. When you shorten supply chains, when you pay domestic workers instead of offshore workers, when you build redundant capacity for resilience rather than lean capacity for efficiency, things cost more. That's not a bug, that's the price of security, but it has massive implications for your money. Here's the math that most people aren't doing. If inflation runs at just 1% higher than it did during the globalization era, just 1%, and you're sitting in a portfolio heavy on bonds and traditional fixed income, the real return on your money over 20 years looks dramatically different. A bond yielding 4% with 2% inflation gives you 2% real return. The same bond with 3% inflation gives you 1% real return. That difference, compounded over a 20-year retirement, is the difference between financial security and quietly running out of money in your 70s. Now, you might be thinking, okay, Smith, I hear you, the world is changing, but what exactly am I supposed to do? I'm not a hedge fund. I can't just restructure my entire portfolio overnight. Fair point. And this is where I want to get practical with you because everything I've said up to now is meaningless unless it translates into decisions you can actually make. First, audit your current exposure. Pull up your portfolio right now and look at where your largest holdings actually make their money. Not where the company is headquartered, but where the revenue comes from. A company headquartered in Delaware, but generating 60% of its revenue from Chinese consumers has very different risk than it did 5 years ago. Index funds look diversified on the surface, but can be shockingly concentrated in multinationals with exactly the kind of cross-block exposure that carries elevated risk in this new environment. Second, look seriously at sectors that benefit from the build-it-at-home wave. Domestic manufacturing, industrial automation, energy infrastructure, defense technology, domestic commodity production. These aren't exciting stories. They don't have viral moments, but they have decade-long government contracts, pricing power, and supply-demand dynamics that favor them structurally. Boring in this environment is often beautiful. Third, rethink your relationship with hard assets. In a world where currency values are being deliberately managed by governments running large deficits, where inflation is structurally higher, and where the global reserve currency system faces its first real challenge in 80 years, real assets matter more than they did when everything was deflationary. Real estate in supply-constrained markets, commodity producers, infrastructure, gold, not as a panic trade, but as a small, consistent allocation to something that can't be printed. Fourth, and I want to say this clearly because I think it's the most underappreciated insight in this whole conversation, geography matters again. After decades of the market is the market, regional differentiation is coming back in a huge way. The countries that are well positioned in this new world order, that have domestic energy, critical mineral resources, stable institutions, skilled workforces, and strong alliance networks, are going to compound wealth differently than countries that don't. Looking beyond your home country, not for the exotic diversification story of the globalization era, but for the strategic positioning story of the new era is genuinely important. India, for example, is often discussed as the next China manufacturing story, and on the surface that's true. Massive young workforce, growing middle class, English-speaking professional class, democratic institutions that make it an easier partner for Western companies. But the deeper story is that India is actively positioning itself as a non-aligned beneficiary of deglobalization. It takes investment from the West and trade relationships with both blocs. That's a strategic position that could generate extraordinary returns over the next 20 years. Here's the thing about major structural transitions. They always feel uncertain from the inside. When you're living through a transition, it feels like chaos. But when you look back at them from 20 years later, they look like obvious, incredible investment opportunities. The shift from agriculture to industry in the early 20th century, the rise of the consumer economy after World War II, the technology revolution of the 1990s, every one of these transitions minted new fortunes and destroyed old ones, not based on luck, based on whether investors understood what was actually changing and positioned accordingly. We are in one of those moments right now. The globalization era that defined investing for 40 years is ending. The new era, call it whatever you want, multipolar world, new world order, deglobalization, is beginning, and it has different winners and different losers than the old era. The investors who win in this new era won't necessarily be the ones who are smartest or who have access to the best information. They'll be the ones who are willing to question the assumptions baked into their current portfolio. They'll be the ones who can sit with the discomfort of moving away from what worked for the last 2 decades, even when all the financial media is still talking as if the old rules apply. They'll be the ones who understand that patience in this context doesn't mean passively holding an index and hoping for the best. It means actively positioning in the sectors and geographies and asset classes that benefit from the world as it is becoming, not as it was. You don't need to get every call right. You don't need to predict which specific companies win. You just need to understand the direction of the tide. And the tide, clearly, unmistakably, with every trade dispute and factory groundbreaking and geopolitical realignment, is flowing away from the old globalized world and towards something new. The question isn't whether the world is changing. It clearly is. The question is whether your portfolio knows it yet. Take 30 minutes this week. That's it. Pull up your largest holdings, look at where their geographic revenue exposure, look at their supply chain dependencies. Ask yourself honestly, does this investment benefit from a more fragmented, more domestically oriented, more inflationary world, or does it depend on conditions that are quietly disappearing? That 30-minute exercise could be worth more to your retirement than anything else you do this year. The end of globalization isn't the end of opportunity. It's the beginning of a different kind of opportunity. The investors who understand that right now, while most people are still operating on autopilot, those are the people who are going to look back on this moment as the turning point. Don't be the person who figures that out 5 years too late.